Yes, we're quite pleased with how the performance was in the quarter. So yeah, modest return, only up 1.1% on an absolute basis. But when you look at it relative to global markets, Canadian market, US market, European market, principal markets in Asia, they were all down double digits. Equity markets were all down double digit during that quarter. It was actually pretty bad quarter, and December was one of the worst Decembers in decades. And so to see the portfolio hold up and be resistant amidst all of that was quite reassuring, and it's exactly how the portfolio is meant to behave. So it was nice to see that it did, and we had good outperformance on the private asset side, and also we had the benefit of diversification across different markets and currencies.
So in terms of the design of it, as you say, it is designed to withstand some of the noise. Do we give up outsized returns in up markets in order to get that sort of hedging effect, or do you just happen to have some good sort of contrarian plays here that worked for you in the quarter?
I think the portfolio is designed to outperform over the long term. And if you look at the long-term returns, 10% return for 10 years is that's very very robust. Mm-hmm. So I think we're quite pleased with those longer-term returns as well. And yeah, it's going to give up some upside in a really frothy market, and but it should outperform in a down market as well. So over the longer term, you'll see good solid performance.
How much of the returns were currency related? The Canadian dollar weakening against some of the investments outside of Canada.
Well, that was a significant portion of the gain. I say that geographical diversification helps. So when we had losses on the direct investment portfolio, they were offset by that currency gain from being diversified into different markets. So that really did help in the quarter.
You have talked about the long-term trends that you're interested in. China is one of them, obviously very much in the news at the moment in terms of making progress on trade. We're talking about Huawei in Canada. Just characterize your thinking around China as a long-term place for Canadian investment.
Yeah, and to give a little bit of a longer-term perspective, China was a market we started investing in over 10 years ago when we first became an active investor. In fact, Hong Kong was the first international office we opened back in 2008. So we've been investing in China and gradually and slowly increasing our investments there for many years. We invest with international partners such as the Australian group Goodman, where we invest in logistics warehouses around China, or with the Singaporean group Capital Land, where we invest in shopping malls and mixed-use development. And then we've invested in some of the leading Chinese companies. For example, Alibaba is probably the most well-known investment, where we invested back in 2011, and it's been a terrific investment. We're about the 35th largest shareholder in that company today. Mm-hmm. And overall, we have just over 8% of the portfolio invested in China. And if you compare that to the US, we have somewhere between 35 and 40%, depending on how you calculate it, of exposure to the US. So that's by far the biggest market. And the two main reasons why we invest in China, the first is diversification. And China today is the second largest capital market in the world. So it offers a huge opportunity for diversification. And we have access to most of, if not all of that market, whether it's public or private or equity or debt. Mm-hmm. And then the second thing is an opportunity for alpha or outperformance relative to the markets. And some of those markets in China are quite inefficient. You probably know the equity market is very retail-driven, very individual investor-driven, so therefore prone to short-term, sort of rumor-driven trading. So for a fundamental long-term investor who's prepared to do the work, it can offer very significant opportunities for outperformance. So that prudent geographical diversification that we talked about, plus the opportunity for alpha, those two theses and opportunities, they still exist today, and we're happy to sort of carefully and prudently increase our exposure over the long term.
How much does any of the short-term issues, including trade frictions and some security issues that could change some long-term planning of, you can imagine manufacturing bases shifting somewhat. There could be long-term structural changes in the relationship. Does that change your thinking around China if the U.S.-China trade relationship deteriorates or the Canadian-China trade relationship deteriorates?
Well, I think it's one of the big challenges for the world today is that the first and second largest economies in the world trying to figure out what their longer term relationship is, and I think it's not just trade; it's a broader range of issues. Mm-hmm. And as those two economies are negotiating with each other and dealing with each other, they're both slowing down as a result of the sort of first order effects of the friction between the two, and then that's spilling over into just about every other economy and market in the world as a result of the sort of second order impact, third order impact, fourth order impact. So, if we start, Germany's exports, European exports, anybody who's engaged in the international trading system is seeing a slowdown of their markets and trading. And that's impacting domestic demand and confidence as well. And it goes back to companies just holding back on do they have the confidence to build the next plant? Do they have the confidence to hire the next bunch of people or start the new strategy when there's a lot of uncertainty about this relationship and how it will impact every market in the world? So that slows down almost all of the markets in the world, so resolving that would be terrific for the world.
What's your current thinking on risks of recession? That's been kind of the growing concern about the U.S. market, where you're very exposed. Also now increasingly, obviously, Europe showing signs, China slowing naturally. How does that all fit into your thinking?
I think that's a real concern that we have this globalized slowdown, as I say, somewhat as a result of this sort of first, second, third, fourth order impact of these global of these tensions, the U.S.-China tensions. You're right. I mean, Europe is right on the brink of dipping into negative growth. The U.S. is slowing, Canada's slowing, China's slowing. Most markets in the world are slowing, and so there is significant risk. I don't think we'll see recession in the U.S. this year, but most commentators at least look towards next year as a possible risk. But in any event, I think Europe is closer to that risk, and the main challenge is that central banks and governments don't have a lot of capacity to react to re-stimulate growth, given they haven't been able to climb back up to what you would expect to be normalized rates since the financial crisis.
One of the risks that you've identified recently on this network was the risk of the growing pool of illiquid private asset investment. It's something you referred to as an important part of your portfolio. Are you still concerned about the role it could play in any market turmoil that might come?
I think it's one of those things that we think is important to keep an eye on. So it's something that we as a fund are very, very comfortable with the level of private exposure we have. We do an enormous amount of risk analysis, liquidity analysis, making sure we have huge reserves, and making sure we're very aware and alive to any of the risks of dislocation in markets. But it's an issue that while not pointing any fingers, I think there's an enormous appetite for private assets around the world. People have and continue to grow their private assets. There's $3 trillion of private equity investments in the world alone at the moment. And most LPs in private equity say that they want to increase that in the next year or so. Mm-hmm. So it's a growing pool. Infrastructure, there's a huge pool of capital and growing pool of capital invested in infrastructure. And private credit has been one of the hottest areas of the last several years of people building in-house and external teams to invest in private credit. And I do think that come a downturn, when some of these funds need liquidity to pay the obligations that they have, or sovereign funds, the countries say, well, we need a piece of that money. they may find that this illiquid portfolio is very difficult to get money from to pay those obligations, and therefore they're going to have to sell the liquid assets. And then we're in a world where banks have limited inventory, where a lot of the trading is algorithm driven, and when they see a pattern of what's meant to be super liquid, super high quality assets being sold, it can trigger things happening in markets. And we saw that a little bit almost exactly this time last year in the volatility markets in the US. We've seen it, we saw it in December in some of the credit markets, just that dislocation, a bit steeper than you would expect normally. And so it just gives a little glimpse of what could happen. So it's something that we watch very carefully.
One other trend that we've identified is the growing pool of cash that the asset managers are moving into. We've seen an increase in the amount of money in cash. What does that say to you about where sentiment is right now?
Well, that's not necessarily a bad thing given the outlook for the world, where I think asset returns are probably going to be more modest for the next several years, given all the economic factors that I talked about. And so, there is, but that caution also can be self-perpetuating, because if companies are not prepared to invest, then it creates that cycle of people pulling in horns and downturns in the economy. So it's important to keep confidence at a sufficient level where there's a decent amount of investment. But I think people shouldn't expect the returns on their investments generally in asset markets that they've seen in the last 10 years. I don't think that's going to happen for the next few.
Are you recalibrating your own thinking about long-term returns that you can count on? As you note, you've had fairly stellar performance. What do you bank on as you look down the road?
I mean, we don't bank on those returns continuing. We aim for the highest possible risk-adjusted returns we can get. So we have a sustainable pool of capital for the retirement of the 20 million people in Canada. But so 10% returns for 10 years has been terrific. 11% for 5 years. These are great numbers. I would expect, and it's always difficult to predict, and almost the most difficult thing to predict what returns will be in the future. But I would expect they're going to be more modest in the future.
And then finally, as we talk about sort of the potential for a slowdown, this kind of market that's behaving in some new ways, including these illiquid ways, do you worry about hidden risks? In the past, it's been the unwitting transfer of risk to a large pool of investors that caused a real market dislocation in the credit crisis. Do we worry about that here? Could that be happening in the same way?
Well, it's a very good point, and that was one of the things that in the last financial crisis, those of us who lived through that will remember that one of the reassurances was, don't worry, the risk is very well diversified, dispersed across the system, so it's fine. But the challenge with that was then people didn't know where it would pop up, and it popped up in unusually concentrated places. So it's something that we again keep an eye on, and don't take huge amounts of reassurance when people say, oh, don't worry, a risk is dispersed across markets. We want to know where it is.